Okay, here is part 2. Alexa, turn down. Alexa, pause. Sorry, guys. So here's part 2. So part 1 is we're figuring out all of these total assets. The next part is called liabilities, long-term liabilities. Now these are loans that the company is going to take out, and they have more than a year to pay these back. So some of the loans that you could have, you would have a mortgage, if I can spell it, mort. You would have a mortgage. Let me mark this one because you need this one too. And the mortgage on our building is $500. Run down. The next long-term loan that you could have in here is called a debenture. These are like bonds. So bonds, you could issue long-term bonds and companies could buy them and invest, and you're going to have to pay those long-term debentures back. It's more of a British term than anything, but they throw that in there for us on an exam, or I will, and we can think of it as a company is issuing bonds. People can buy the bonds as an investment, and then you're going to have to eventually pay those bonds back over a course of many years. So the bonds, we'll make that $500. And then of course, you're probably going to have some sort of bank loans to finance. And we'll say that's $100. So let me see if I can insert a row here. Insert row. Ooh, look at that, I did it. So your total long-term liabilities are $1,100. So remember the liabilities, this here, this is one of the ways that we're going to pay for all of that stuff that's going on up there. So once we figure out this long-term liabilities, we need a number that is called net assets. In net assets, that number is taking your total assets minus your long-term liabilities. Let me mark these so we know. So you take your total assets minus your total long-term liabilities, and you should get net assets, whatever that is. I think 1,060. Okay, so that right there, kiddies, that's the number that that's the number we need right there. So once again, fixed assets, everything that the company owns, minus what they owe, gives you a net asset. Now moving to the last part, there's a thing called owner's equity. So how are we going to pay for these net assets? How are we going to do that? Let me fix this. So you need owner's equity. Sorry, I'm so sorry. It's so hard on the computer. So you need owner's equity. So owner's equity is, you're going to have something called, I'll just say this, shared capital. And this is selling, shares of stock to the public, or if you're a private company, family and friends. So we're going to issue shares of stock. People have invested in us, and we'll say that that's $1,000 worth of shared stock or shared capital. The other way that we're going to finance this number is, remember from retained profits, remember that number came from a statement we just did. So the retained profits are going to be $60, which gives us a total equity of how much? You guessed it. $1,060. That number, sorry, and that number, they have to equal. They have to be in balance. And while you're doing this, you have to show how you're paying for everything that you own. Okay, so the balance sheet helps you to ensure that all the money that's in your organization is accounted for. If it is not, people are stealing from you. Put up the cameras. Red flag. People are stealing. They're cooking the books. Alexa, continue.
Hey, JC Seneca here from Nader.